Good afternoon, everyone. Thank you for joining us. We only seem to have a few attendees at the moment, so we'll give it another minute or so in the hope that others will be joining us. We are expecting rather more. Now it looks like the numbers are beginning to come up, so we'll give it 30 seconds or so, and I will then give an introduction on behalf of the centre. My name's Chris Horridge. I'm the senior advisor at the centre, and then hand over to David, who will be moderating the panel discussion today. In the meantime, you can admire the views of all our panelists. I'll get started anyway. My introduction is not a particularly exciting thing for anyone, so hopefully more will join while I'm doing that, and by the time David gets to introduce the discussion properly. So again, thank you very much for joining us. One thing to let you know before we start is that we are recording the session. Please don't let that put you off from joining in with questions and comments as we go. And the video recording will be made available through the centre's website after the event for those people who couldn't make it, and in case you want to either watch it again or share it with your own contacts. Now, one of the things that the IoD Centre for Corporate Governance has been focusing on over the last 12 months or so is the issue of stakeholder governance. And if you would go onto our website, you'll see there's quite a lot of reports, videos, and other such material there on different aspects of that topic. A lot of the public debate and discussion tends to focus on stakeholders in relation to listed companies, but I think the view of the centre is that it's equally important for all sectors of the economy. And for that reason, we've been running a series of webinars looking at some of those sectors and the stakeholder issues there. Well, we kicked that off a couple of months back with a webinar on higher education sector, and today obviously we're focusing on private equity. We're very pleased to have David Trenchard from Elliott Advisors moderating the discussion. David is also a member of the Centre's advisory board, and I will now hand over to him to say more about the topic and to introduce the panelists. So David, over to you.
Thanks very much, Chris. As Chris said, I'm David Trenchard. I fairly recently joined Elliott Advisors in London, working with them on a number of their public and private equity investments. So working for a hedge fund, I can no longer wear a tie, so apologies, I seem to be the only panelist not wearing a tie this morning, but the topic is obviously very relevant to me. As Chris mentioned, I was, Chris didn't mention, I was a member of the council of the IoD for a couple of terms, so I was delighted to be invited to join this advisory board of the Centre for Corporate Governance. As Chris also mentioned, we've spent a lot of time looking at many aspects of stakeholder governance and engagement, but most of our work's been looking at how publicly listed companies behave and how that's been changing. And the deeper we've dived into that subject, the more we've recognised the need to better understand the implications in other sectors of the world, but particularly in this case, private equity-owned companies. But also driving this has been a lot of talk in the markets, a lot of talk of companies in Europe being acquired by private equity buyers. The concern being, of course, that they're removed from the scrutiny of public ownership. There's lots of data sets looking at this. I read a report just last night from BDO, which was talking about the value of public to private deals last year being up 7-fold year on year, which I guess was probably not a fair comparison given the previous year, but it was a £30 billion or so public to private market last year. But however it's measured, it's certainly likely to be a continuing feature of today's markets. A lot of listed company directors are claiming to be frustrated by what they see as low valuations put on their shares. I think the reputation of PE firms as owners has been enhanced enormously, no small part due to some of the people on this call. But I think over the last 20 years or so, going private has become a lot less controversial than perhaps it once was. And private equity firms can often structure more generous share and performance-based incentives for managements and for directors than might be deemed acceptable in the public market. So lots of reasons why this might be happening. But there's a big but, and the but has been, I think for many of us, that public and investor scrutiny of publicly listed companies is very significant. There might be some publicly valid criticisms of the investment industry's history of stewardship, But there's no doubt, certainly in my mind, that shareholders do hold boards to account. They do understand what a director's Section 172 obligations mean for them and for companies. And increasingly, institutional investors, particularly the larger ones, have got very prescriptive policies on social issues, on sustainability, on transition to carbon neutrality, etc. And so you only have to ask boards what a typical investor meeting agenda looks like now to understand how that accountability and scrutiny is being fulfilled. And I think the financial press, which also has had its critics, but I think the financial press has done a pretty good job of holding boards and managements to account. And you just have to look at the forensic way in which the FT uncovered the Wirecard scandal in Germany to see an example of this. So does a company going private or being privately owned give it the opportunity to remove that scrutiny and to avoid the legitimate interests of many of the stakeholders? Can financial sponsors as owners really credibly claim to care about their stakeholders? And perhaps importantly, should they? And how can any commitment to stakeholder issues and ESG be reconciled with the relatively short ownership horizon of most PE firms? I noticed Larry Fink spoke at COP26, and he was quoted in the FT as saying, private markets where companies can get away with minimal disclosures about their businesses. They've been criticised as the underworld where polluting assets can go to hide. It moves from publicly disclosed companies to opaque private enterprises. So these are some of the issues we've been trying to better understand. So I'm really delighted to have such an impressive group of people today to help us shed some light on this potentially shadowy world. So the panel we have with us today comprises Louise Corner, who's a partner at Phoenix Equity Partners, Shai Hill, the founder and chief executive of Integrum ESG, Michaela Marikian, who's head of ESG advisory at Greenbrook Communications, Janet Williamson, who's the senior policy officer at the TUC, and Simon Whitney, who's a senior consultant at Travis Smith, who's also a visiting professor at the LSE, and importantly, the author of the book Corporate Governance and Responsible Investing in Private Equity. So I'm going to ask each of our panelists to introduce themselves and to say a few words giving their views on the topic. But I'm also keen to open up the discussion as much as possible. So we would encourage all of you that have any questions or comments, either to use the chat function or the Q&A box, and we'll attempt to address as many of these questions as possible as we go along. But Simon, as the person who literally wrote the book on this subject, maybe I could ask you to kick this subject off.
Thank you, David. First of all, thank you very much to you, David, and to the Centre for inviting me to participate in this very interesting discussion. As you mentioned, I'm a private equity lawyer by background. I now practice law at Travis Smith and a visiting professor in practice at London School of Economics. I'm a member of the council of the BVCA, the British Venture Capital and Private Equity Association, although obviously I'm not speaking for the BVCA today. And you kindly mentioned my book, David, which is about corporate governance and responsible investment in private equity. And maybe if I could just spend a few minutes making some remarks about some of the things I wrote about in that book, which hopefully might set the scene for the following discussion. My starting point is that corporate governance is at the heart of the private equity business model. To an outsider, that sometimes sounds like an odd thing to say, but I think most people who know the private equity industry well would agree with that statement. And that's because the private equity playbook at its heart is in large part about establishing effective corporate governance structures that can deliver more efficient, more productive, more innovative, and ultimately more valuable companies. And I think there is significant evidence that good corporate governance, by which I mean effective, well-informed decision-making structures, strong oversight and accountability mechanisms, management of material downside risks, there's significant evidence that that's a major source of value creation in private equity. In fact, if you look at the statistics, it's probably the major source of value creation by private equity firms that we see. So that's value creation for the shareholders, certainly. But my own view, and I spend quite a lot of time in the book writing about this, is that private equity's expertise in putting in place these effective governance structures, which they do on a repeat basis for the companies that they invest in, also means that private equity ownership can be, and often is, a force for good for other stakeholders in driving responsible business practices, in helping companies solve problems of people and planet. It's those very same corporate governance mechanisms that I think incentivize and make it possible for private equity-backed companies to really achieve those societal aims, as well as making good returns. And I just want to focus on that for a moment, and in doing so, focus on incentives, because for me, the starting point for any discussion of this type is about incentives. I firmly believe that people respond to the incentives that they're given, to the incentives that they have. And I think that to understand the expected behaviors of private equity-backed companies and how they're going to use their expertise in corporate governance, we really have to understand the incentives of the people that make decisions in private equity-backed companies, which, as we know, is the company's executive management team in combination with the private equity investor that's invested in the private company. And I'm going to focus on two important incentives that are inherent to the private equity model. First, the clear incentive to drive change in companies to make them more valuable in the long term, as I'll explain. And second, the incentive to respond quickly and demonstrably to institutional investor preferences for responsible stewardship. David was just talking about institutional investor preferences and their focus on responsible investment, and I'll explain why I think private equity firms need to and will and do respond to those institutional investor demands. But first, the incentive to make companies more valuable. So private equity firms, as we know, invest in, buy shares in private companies. They have clear incentives themselves. Indeed, up to a point, they have contractual duties to maximize financial returns on the investments they make. That's their business model. Their own investors are mostly institutional investors, mostly pension funds and insurance companies, for instance. And those institutional investors are trying to meet the future needs of their retirees or policyholders, and they usually demand that private equity firms deliver outsized returns for the benefit of their beneficiaries. Private equity firms undoubtedly benefit themselves when they meet those institutional investor expectations for strong returns, as of course do the pension funds, the university endowments, the other savings pots that stand behind those asset managers, asset allocators. So how do private equity firms make those strong returns? Well, mostly they make their returns by selling companies after an average of about 5 to 7 years from when they acquired them. And they make their money by selling those companies for more money than they paid for them. That's the most common way in which private equity firms make money. Who do they sell their companies to? Well, they sell them to well-informed buyers on the whole. Most exits are not by an IPO. They're by sale to a trade buyer or another private equity firm. In other words, knowledgeable buyers who themselves do extensive due diligence on the assets they're acquiring. And what are those buyers focused on? Well, they're focused on how well that company is going to perform over the next 5 to 10 years and indeed beyond. They're not focused on what's happened over the last 5 years, except to the extent that it makes the company more valuable for the next 5, whilst they are the owner of the business. So investing time in a company during the 5 years or so that a private equity firm has influence over its strategy and decision-making, investing time to make that company more valuable is a highly rewarding, highly incentivized activity. And making it more valuable, making that business more saleable to a well-informed buyer who's focused on the future, means focusing on the long-term prospects of the business. A buyer does not want to buy a business that's got poor future prospects, but they'll pay handsomely for one that will generate sustainable value, sustainable returns for the foreseeable future. So private equity firms have an incentive to make companies more valuable, that's clear, and more valuable to a buyer in 5 to 7 years' time. In turn, they're highly sophisticated people. They're extremely well placed to assess the likely impact of long-term societal and regulatory trends on the value of the businesses they own. So what they need to do today, what they're actually really good at doing, is anticipating the preferences of buyers and therefore in turn the underlying long-term business drivers that they will face in 5 years' time when they come to sell. That business model means that private equity is, contrary to many expectations, an inherently long-term business. You are looking at the future. You are looking at the 5-year plan. You are looking at how you're going to make a company more valuable during that period so that it's more valuable at the end of that period. If you focus on the short term, for the most part, and of course there are exceptions, but for the most part, if you focus on the short term in a business, you're not going to make money, you're not going to succeed. So what that means is that if ESG or sustainability issues are issues that are relevant to long-term value, and as we know, most of them are increasingly so because regulatory environments are shifting, stakeholder preferences are changing. If ESG or sustainability issues are relevant to long-term value creation, then we would certainly expect a private equity firm to be focused on those issues and to be reactive to them. And indeed, that's what we see in practice. Relatively small, well-informed boards of directors meeting regularly, actively focused on the value drivers in the business. That's what private equity firms do. These boards are highly motivated, have powerful incentive to focus on what's going to make the company more valuable whilst they are the owners. They generally have a plan and they are determined to execute that plan. And they respond really quickly when the world changes, as we saw during the pandemic, rolling the sleeves up and really trying to understand how changes in the external environment affect the business and its future prospects. So if ESG matters are financially material, meaning they affect long-term risk and long-term value, private equity firms will respond quickly and effective to them. If they don't, they won't survive long. And as I've said, shifting consumer behaviors, rapidly changing regulation, physical and transitional risks associated with climate change, degradation of biodiversity and nature, these are all financial risks. And most people in the private equity sector now understand that. Building a loyal and satisfied workforce, long-term customer loyalties, these are not only ethical issues, they're not only the right thing to do, but they are what makes a company more valuable. They are financial opportunities. So I think that's one set of incentives. And if you allow me, I'll just turn briefly to the second of the incentives that I wanted to talk about. Leaders of a private equity firm aren't only worried about making their companies more valuable. They're worried about that, as I've just explained, but they're also worried about something else. As I've already said, private equity firms raise money overwhelmingly from institutional investors. These are generally the same institutional investors that invest in publicly traded companies. It might be a slightly different part of the institutional investor that looks after their private markets exposure, but generally they're the same underlying institutions. And because private equity funds are limited life, that means they don't tend to reinvest the proceeds of investments when they sell them after 3, 5, 7 years. They have to go and raise a new fund every 3 years or so. In fact, multi-strategy managers are raising new funds all the time, but even a single line private equity fund manager goes back to investors every 3 years or so to raise a new fund. There's complete transparency between the fund manager, the general partner, and its investors. These investors do lots of due diligence before they invest. They get very regular reports on an ongoing basis. They negotiate the terms of their investment, frequently now imposing their requirements for ethical or responsible or sustainable investment on the underlying managers in an ESG policy. So private equity firms therefore have high-powered incentives to respond to those institutional investor preferences. If they don't, they won't raise their next fund, or they'll raise a smaller fund at least. And we know that these investors care about sustainability issues, right? A survey published earlier this year by Bain & Company underlines that. It said that a vast majority of investors in private equity funds, over 80% of them in Europe, now have an ESG policy that governs their private markets investment activity. According to Bain, ESG is now a mainstream consideration for investors in private equity, especially climate change and diversity and inclusion. And I know from my own practice that these investors in private equity, these LPs, demand more information on sustainability than they used to, much more, and their demands are increasing all the time. So private equity firms are, as you'd expect, responding. They'd be mad not to. And it's clear that in response to these institutional demands for more sustainable investment, private equity firms are also raising many more impact-focused funds, and many of them will do that more so in the next 5 years. They are uniquely well placed to have positive impact with their approach to governance, as I've argued. Close oversight of and where necessary involvement in strategy and major operational decisions, detailed reporting, control over management incentives. These all mean that if you want to have positive impact in your portfolio companies, if you've promised that to investors, you're well placed to do so. So let me just conclude. I think I've had my allotted time, but let me just conclude briefly by saying Of course, we'd expect all commercial companies, public or private, to be responsive to changes that affect long-term value of their business. But I think there are reasons to think that private equity-backed businesses are super responsive to those changes. They have the incentives to be super responsive to those changes. For example, if an engaged and productive workforce, loyal and satisfied customers, low carbon business models, if these things will make a company more valuable in 5 years' time, then a private equity firm will help the company to achieve that, because that's how they will make their money. And in fact, even legal, regulatory and societal changes that have no impact on financial impact value of the business per se might still be expected to affect behavior, because ultimate investors in private equity funds care about those issues and increasingly ask, and will increasingly ask, searching questions about them and do due diligence on them. So I think that that means that private equity can be, and often is, a part of the solution to our problems rather than a part of the problem. I'm not going to argue, of course, that every private equity-backed business is a success story for its private equity owners or for other stakeholders, and not all private equity firms are alike. But I think that in general, private equity as an ownership and governance model has the potential to deliver better, more productive companies for the benefit of wider stakeholders, for the benefit of society and the environment. And in many, many cases, that is what I see it doing in practice.
Thanks, Simon. That's fascinating. I should have said, Simon, the book's available from all good retailers, online and otherwise. Louise, I imagine that you don't have an awful lot that you would disagree with that Simon has said, but it'd be very interesting to hear your perspective. If you could just introduce yourself and let us know your perspective from the Phoenix angle, that would be very helpful to hear. Thanks.
Sure, happy to. So pleasure to be here, and thank you, Simon, for demystifying what us PE owners actually do, and for making the case. Just to sort of position myself and Phoenix within the broader private equity world, I'm a partner here responsible for essentially portfolio performance and monitoring how our companies are trading post-investment and investor relations. And we're a long-established private equity firm here in the UK, investing in UK headquartered companies, principally as the first institutional investor in those businesses. So we're helping founders and entrepreneurs in partnership to grow their businesses. And we are not venture investors, so we're investing in profitable businesses, but typically sort of mid to high single-digit profit, just to give you an idea. Investing in subsectors of the UK economy that we know very well, and typically investing in service businesses with a high degree of tech enablement, which I think is relevant to the ESG discussion. As a firm, we've been signatories of the UN-supported Principles for Responsible Investment for many years now, and we seek to be responsible owners of businesses. And, you know, as Simon has presented brilliantly well, the G in ESG is essentially what we do in private equity, what we do here at Phoenix. And it's particularly relevant at the stage in which we get involved with companies, because they may not have had appropriate governance structures in place in the past. So things like proper board composition, committees, policies are all a given. They're the things we will literally put in, you know, day one of our investment, that just helps that sort of multi-layered governance structure that Simon alluded to. So we do seek to be responsible owners. We are also active owners of businesses. So coupled with I suppose, the formal governance, we like to really roll our sleeves up, you know, work in partnership with management teams to grow and develop the business and solve problems together. As Simon said, ultimately, our institutional investors are backing us to generate a financial return for them, and we think that is the best way to do that. It also means we can have significant influence. And I thought it might be helpful just to talk really in practical terms about our approach as regards ESG, because I think that's important. And we think about ESG considerations at every point of the sort of investment life cycle, if you like. Our approach at Phoenix is to have an ESG committee made up of senior Phoenix team members, but we didn't want one individual responsible for the ESG agenda. You know, the Phoenix team buys into what we're doing, and all of the members of the committee, which includes myself, have different perspectives, may have different touch points with different stakeholders. So it's a really valuable sort of discussion forum for what our approach should be. And then in terms of how we approach it with our companies, with our management teams, we do a lot of due diligence before we invest in a business. So ESG is one of the many things we do due diligence, both to identify risks and opportunities. But what we want to do is that make sure day one, we are in a position to either sort of capitalize on those or take steps where we think there is some potential risk. Clearly, if there's a real problem, we may not invest in the business in the first place, but understanding what we're getting involved with is really important. We then also, I suppose, bake in our requirements into legal documents, terms of reference of the chairman of the board, for example, such that sustainability and ESG is on the agenda day one. But then in terms of sort of trying to see results, I suppose what we've done for many years is collect and monitor ESG KPIs across our portfolio. I'm sure this sort of data collection question was one we'll come back to later on in this webinar, but if you don't measure it, you can't improve it. And we have a number of core KPIs that we collect across our portfolio and encourage each company to focus on their sort of specifically relevant KPIs as well. And those are reported to us, but also presented in the board packs for our portfolio companies. So it means that ESG is on the agenda at the board. There's a discussion around it. It's thrown up some very interesting things. And this is where this sort of the fact that ESG and sustainability and financial gain are inextricably linked. Just to give you an example, one of our companies saw quite a spike in their employee churn, which for us, it was an ESG KPI, but it's a business KPI just like any other. And they were really able to address that with some changes to how they approach sort of the culture of the business and the incentives to the employees and so on. So measure the KPIs. But really as a means to see the improvement, but also just to encourage debate at our portfolio companies. The last thing I would say is we have the benefit of being investors in a number of companies. So at any one time, let's say we might have 16 companies that we're invested in. So there's a lot of best practice sharing that can go on. So we have a monthly senior management call, for example, that involves any senior managers across our portfolio that would like to join. And, it's sort of breath of fresh air to hear them saying, we'd really like to talk about ESG. We'd really like to, whereas a few years ago, I feel like maybe you were pushing water uphill with some of the more cynical management team members. There's definitely been a change there. And we've got some real leading lights in our portfolio. So we have a pensions investment consultancy, which was the first to embed net zero into its investment advice. That is a great thing for other companies to hear. We have an operator of woodland cabin sites that champions sustainability. And we've got 3 companies applying for B Corp status. So, there is sort of a positive effect of this ecosystem that we have in being investors in multiple companies. I suspect I've probably run out of time. There are many other things I could say, but I'm happy to pass over at that point and sort of expand when we get into some debate. Oh, David, you're on mute.
So you would think after 2 years we'd have learned how, or I'd have learned how to do this, wouldn't you? Thanks, there were some great examples. Shai, I'd like you to introduce yourself and the company, but as an observer of the industry as well, it'd be interesting to get your perspective as to whether what we're seeing here is the best of the industry, and there are other examples that perhaps are less encouraging. But let's hear your views. And you too are on mute, Shai.
Sorry, can you hear me now?
Yep.
Sorry, I'm actually speaking to you from the office and it's actually quite noisy. Apologies. So yes, thank you. I'm the CEO, my name's Shai Hill, and I'm the CEO of Integrum ESG. And just to be clear what we do, we're not a private equity firm or a consultancy firm. Essentially, we're a data firm. So what we do is offer ESG assessments, that is to say scores, comparatives against their peer group, and surfacing the underlying data that explains those scores. We do that for both public and private companies overall. So we do, amongst their clients now, have some private equity firms, and they are using us to basically collect, score and benchmark ESG data on their portfolio companies overall. So that's just a simple view on what we do. Do I think, in terms of the title, that ESG is a casualty of private ownership? I suppose no, I don't think it's a casualty, because I think that a lot of these companies, when acquired, weren't really doing a lot in terms of ESG data collection and monitoring to begin with. So I don't think, Larry Fink's point is, obviously talking his own book, is, what private equity companies do is they take companies off the public market and then they disappear into this dark world where they don't take these things seriously, they don't produce any data. That's not typically, that's just a fact. And the vast majority of private equity investment isn't about taking public companies private. Just the same as, to Simon's point, the vast majority of exits aren't actually to the public markets. It's about acquiring companies that were already private and then often selling them on to another trade buyer or private equity companies. So I think a lot of these companies, and that is the real challenge, weren't doing a lot in terms of ESG to begin with. And what does that mean? Not doing a lot. Well, it starts with the data. And some of our audience will say, well, you would say that, wouldn't you? Because you're a data company. But the point is, I think Louise said it as a business cliche, you can't manage, what you don't measure, right? By definition, Louise's company is providing metrics and shoving them in the directors' faces. I'm sure it's a lot more polite than that, but they're basically saying, look, this isn't just for us and our investors. This is for you, the board running this company. Look at your staff turnover. That's not value generating, is it? Do something about it. So when I say they're not doing much, these companies, the trouble is they're not really collecting it. I mean, when I'll just give us a commercial insight, when we sort of launched last year for private equities, and we said, we can do this for you, for all your private companies, because we've built this super clever AI systems. Just give us all the reports, ESG reports and the data. We'll parse them and hand it back to you, all tabulated and formed. And the private equity companies come back to us and say, that's the problem. There aren't any reports. And we'd say, well, haven't you been asking them to sort of prepare ESG sustainability reports? I said, no, that's a public company thing. We haven't really been doing that. Now, let me just actually be a bit more specific. The vast majority of private equity firms that we're engaged in did an awful lot at acquisition. So that would be a typical method. They bought the company, they did a full ESG review, they went through all the operating margins and the metrics. They got themselves comfortable with the ESG performance of that company at the point of acquisition. They often paid a third-party ESG consultant to do that work for them. They took that report, they put it in the drawer. The years have rolled past, that done 4 years ago, and none of that data has been updated since. And that is the case for the majority of private equity firms. The point is about a panel, with any panel that I appear on, by definition, we've got panels of people who take it very seriously. Louise's firm takes it very seriously, right? And she's on this panel because she understands it, she knows it, she can talk about all the details of what they are doing. The majority of private equities don't. And I'll disagree with Simon then slightly, if I may, which is to say that first of all, a lot of private equity companies don't think it's a value driver, with the clear exception of G. So let's talk about E, S and G, quite different things. And you often have an intense focus on G. It is their lifeblood, and I completely agree with what Simon and Louise have said on that. As to the E and the S, it's often something they have not thought is a driver of value. And there are many surveys, Simon cited them, in which people say, I think it's an incredibly important driver of value, but some surveys in ESG especially need to be taken with a pinch of salt, David. It's like go and do a survey like, are you really upset by the fact that the Amazon rainforest is being cut down again? You'll get 90% of people will say, yeah, I think it's really upset by it, and I think it's really quite a serious issue. And then you ask them, well, what are you doing about it? And the answer is nothing. So what we're finding with a lot of private equity companies is actually they don't really think it's a great driver of value themselves. They don't have very detailed anti-arguments. It's just not something they've been particularly focused on. And a lot of GPs are very, very busy people focusing on a number of operational and financial metrics all the time, and potential new investment companies. Some of them are wary to burden their companies with the data collection. Right? So some of them would do a tick box, a sort of midway tick box, like give us these 5 stats, universal stats, which might not be relevant. Tell us what your carbon emissions are. Okay, well, the portfolio company is a mid-size advertising company, based in the UK. I mean, the carbon emissions is just not financially material, right? So they'll capture a limited number of what are called universal, not sector-specific stats to do that. Often they're not doing it at all. In the pressure, though, things are changing. So I don't want to say no one cares about it. There is change going on, very clearly cultural change within private equity firms at large, right? And I'm talking at large. So I'm not talking about the people on this panel who are very focused on ESG. And I'm also leaving out what I call the behemoths. So for example, we had lots of discussions with KKR. Right? KKR are taking ESG incredibly seriously. Right? They do a huge amount of analysis on all their portfolio companies. In fact, they recently acquired one of the leading ESG consultancies, ERM, that they wholly own, and then make them review and consult on every one of their companies. So some of the behemoths are taking it incredibly seriously. Some of the specialists here are, but the majority are moving very slowly. What are the drivers for change for them, in my opinion? Regulation is a part driver. They've largely ignored shareholder rights directive. I'm sure none of Simon's clients have, but the ones that we speak to have largely ignored the directives in SRD2, but a lot of them are taking SFDR quite seriously. And I'm concerned this is going to switch off a lot of our audience as we start to get detailed in terms of the regulation. But it's a disclosure and reporting requirement that basically says if you want to market your fund in Europe, you have to do this ESG type analysis at a quite detailed level. So that is a part driver, I think, for some of them. The biggest driver is their LPs. Right, the investors in the private equity firms. So again, for those of you who are not specialists on there, you've got the people running these private equity firms, GPs, general partners, and then the institutions that Simon referred to, the pension funds, insurance companies, the limited partners, the LPs. The driver is more and more LPs are starting to what I call whinge at the companies that they're not including really any ESG data in their report. Right, most of it is very operational, very strategic, and doesn't actually have much ESG data. Some will say, no, our LPs have some very specific demands. Those are often at the GP level. So they go to the private equity firm, they say, we want you, the private equity firm, you yourself are an opco, and we want you to commit to doing these things yourself. The demands that have come from LPs so far, a lot of the cases aren't going into the portfolio companies and say, we expect this codes of behavior and codes of disclosure in the portfolio company level, but it is starting. So the thing that I'm very optimistic about is that this is undoubtedly starting, and this is the trend that I am seeing, which is LPs who didn't invest for ESG reasons. They invested because they want to see supernormal returns out of a 5-year private portfolio, but they are starting to say, at a limited number, but some of the bigger, strong voices are saying to the GPs, this quarterly report you send us simply isn't good enough. I mean, the word emissions, the word diversity doesn't even appear in there, and we expect you to do better. And the GPs are then saying, trouble is we don't collect that data, other than for a couple of companies where we think it's specifically financially relevant. So they are starting to have to address that in terms of that data collection. And I do think we're at a point of change, but I don't agree that most private equity firms have been doing this, are highly incentivized to monitor and disclose on ESG, and that they all agree. Why wouldn't they? Because it's a clear driver of value. I think we're actually quite early stage in a journey. And when I compare private equity investment firms to public investment institutions, then the average private equity firm is probably 2 years behind their public equity investment counterpart in terms of the focus and detail they've placed on ESG analysis.
Thanks, Shai. That's somewhat more sobering. I think fascinating, really interesting. Janet, I wanted to bring you in. Clearly, you represent a very important stakeholder in this whole discussion. I realize you're probably speaking as an individual rather than as a representative of the TUC, and I know that you have, because you and I have spoken about these things in the past, I know you have much broader views than purely those of employees, but certainly interesting to get your perspective here.
Yeah, thanks very much, David, and thanks to the other speakers. Been really interesting so far. So yeah, I'm a senior policy officer at the TUC, and I lead the TUC's work on corporate governance, and I am representing the TUC. So yeah, I'm kind of speaking that capacity, and we'll primarily talk about workforce issues or a wider set of issues that nonetheless affect the workforce. Yeah, I mean, I do bring a slightly a different view to bear on this discussion, or certainly a little bit different perhaps from Simon's, though I found that very interesting. You know, based really on the experience of our members and their members who've experienced private equity buyouts. So I guess that we have a number of concerns relating to the private equity model. The first one I'll start with, and the main one, is the impact on the workforce, and that is in terms of employment levels, wages, terms and conditions, and workforce voice. And I mean, unions have kind of, you know, raised concerns over many years now about the impact of private equity buyouts on the workforce of the companies that are bought. And you know, the experience in sort of, you know, broad general terms is of quite often of wage cuts, of other deterioration in terms and conditions. Sometimes it's more about wages being held down and not kind of increasing. There's, I mean, I don't know if people kind of caught in the media relatively recently, there was a big dispute at Clark's, which was bought by private equity, not a UK fund in fact, but anyway, which then tried to implement a fire and rehire strategy. So in other words, firing the whole workforce and hiring them back on weaker terms and conditions. The private equity fund argued for months that they had no choice about that. They did finally back down after a lot of pressure on the fund and talks at ACAS. So I guess they did have a choice after all, as it turned out. So, I mean, the sector, I think, has quite often defended itself on the grounds that private equity buyouts are often, you know, or in some cases they target, you know, so-called distressed companies. But there has been quite a lot of academic research that, you know, has taken account of this and sort of, you know, comparing like for like and using control groups of similar companies, has found that private equity buyouts do tend to be associated with job losses and holding down of wages, and that certainly does tally with the experience of unions. Another issue that the unions have found in the context of private equity buyouts is that their relationship with company managers are often quite severely disrupted. And you know, I think some of that's about the fact that sometimes the managers find that they can't really make any decisions. You know, they're not in the driving seat anymore because it's the private equity fund which is now in the driving seat, and the union therefore doesn't really have a viable partner to discuss issues with or even to get information from. That's been a kind of quite a repeated issue. Back quite a long time ago, I think around like 2007 and 8, various you know, other kind of more dated examples of that happening led to the TUC and the British Venture Capital Association sort of agreeing a kind of sort of protocol whereby the two organisations would, in a sense, try to use their, you know, our good offices to work together if that kind of an issue came up. And yeah, we did look at it using it with the Clark's case, but in fact, Line Capital is not a BVCA member, so that you know, that wasn't able to happen. But that protocol is there for a reason, because you know, unions can have a very good relationship with the company, a productive relationship, which can be completely sort of, you know, disrupted by private equity buyout. Some of the other concerns that we have about the private equity model and its kind of long-term impact on workforce interests, and indeed the interests of other stakeholders, and indeed on the portfolio company itself. I mean, a common you know, private equity sort of you know, practice, if you like, is to rely heavily on debt to fund buyouts and then transfer the debt to the portfolio company after the buyout. And that can obviously create significant risk in terms of the sustainability and viability of the portfolio company. So that's something that you see and the unions are very concerned about, and the fact that often, you know, the kind of high levels of leverage used in private equity buyouts at the end of the day get transferred, you know, to company stakeholders and sort of in particular the workforce. So I think there's something around the use of leverage and the extent of it, the high levels of leverage, which can create, you know, inherent sort of risk and lack of sustainability. Another common practice, this is not restricted to private equity, I must, you know, kind of stress, but it is commonly used by private equity portfolio companies, is to kind of known as, you know, sale and lease back of property, you know, basically to sell the real estate of the company to a holding company, and then require the portfolio company to pay rent on to the holding company. And that model is associated with, you know, quite a high number of high profile and very destructive company failures, you know, including Debenhams and others. But it is very commonly used. It's being used throughout. For example, at the moment, private equity have got quite a significant ownership stake in the care sector, and in all of the kind of, you know, in all of those cases, sale and lease back is being used. Something that we're doing some research on at the moment, and that's not sort of completed, but I would just say that it would appear to be being destructive of those care companies, both in terms of the impact on the people they're caring for, you know, standards of care, which obviously is, you know, a crucial issue, and also the workforce as well. I mean, it's a little bit kind of linked to that, but there's a sort of broader issue, I think, private equity buyouts of, you know, basically financial redistribution. So there's the sale and lease back thing that I've mentioned, but there's often other forms of dividend payments, you know, there can be asset sales, all of which are basically used to generate funds for the owners, but are often not, do not generate any benefit at all for the portfolio company, and indeed can be very destructive of its long-term viability and sustainability. Sometimes, you know, the debt, as I mentioned earlier, is often transferred to the portfolio company, and then, you know, that the company is kind of saddled with heavy debt repayments and interest and so on and so forth. So, you know, all of that basically represents a sort of transfer of wealth from the portfolio company to its private equity owners, and creates pressure on the portfolio company managers to make job cuts, you know, repress wages and conditions for workers. And, you know, that's very much what unions in the sector experienced. So I think at the very kind of heart of our concerns about the private equity model is a real question about in whose interests the private equity owners are acting. So, you know, these kind of strategies, I've talked about the use of excessive leverage, you know, property sale and lease back, financial redistribution. They often serve to weaken the viability of the portfolio company while benefiting the short-term financial interests of the private equity owners. And I think, you know, for me, the issues raised by private equity ownership are not, I wouldn't quite frame it as being around ESG, as being around a potential conflict of interest between the private equity owners on the one hand and their aim of generating significant financial returns over a 5 to 7 year period. I don't think that is a long period in the life of most companies. particularly mature companies, and there are a lot of mature companies which are now, which are bought up by private equity funds. I mean, I appreciate the slightly different argument, perhaps with startups, but anyway, a sort of a conflict potentially between that 5 to 7 year financial return interest and the long-term interests of the company on which the workforce, suppliers, and other stakeholders depend. I think there's also the potential for conflicts of interest between limited partners and general partners, but I won't really go into that here. And of course, I absolutely accept there will be examples of good private equity practice. They don't often come my way. I do tend to hear about the bad examples, and there's quite enough of them to sort of, keep us busy. But overall, I'd argue that the regulatory environment has not really kept pace with the development of private equity and the kind of the role of the sector in terms of its economic assets and impacts. And I mean, David mentioned Section 172 of the Companies Act earlier, and certainly the TUC is concerned that directors' duties, as set out in the Companies Act, are not suited to the fixed time horizons of private equity owners. Again, somebody mentioned disclosure. Well, that's kind of come up throughout the whole discussion. There's been some, welcome developments, I think, narrowing the gap between private and public companies in terms of disclosure requirements. But, nonetheless, the disclosure requirements for private companies do remain considerably weaker than those for quoted companies. And, in our view, disclosure should relate to the size of the company, and in particular its employment footprint and its stakeholder footprint, rather than its ownership structure. That should not, in our view, be what determines disclosure.
Janet, can I ask a question? Sorry, Janet, it's Shai here. Very interested with a lot of your points, and I'm not taking issue with anything about the sort of financial engineering aspects of this. I'm just very interested. It's an open question because I don't know. Is there compelling evidence to show greater wage restraint in private equity owned companies than there is in public companies? You suggested that there was, but I've never seen any data to that effect.
There are academic studies, yes, that sort of compare like for like and have reached that conclusion. Yes, I mean, what I'm kind of talking about is, in a way, is our own experience and particular examples. But yeah, there's academic studies that do show that.
Okay.
In terms of
wage restraint. Can I also just one second question, which is the Clark's example? You give an example of something which was upsetting to a lot of people, and I controversially would say it's not a complete coincidence that the private equity firm in question is Asian based, in the sense that ESG considerations have not yet penetrated the Asian private equity market in any way like the degree they have in the European market. Do you agree with that, or do you think that's just an irrelevance?
I mean, I think I'm not sure I'm going to answer that directly. I don't have a lot of. I'm not going to make a kind of generalization about Asian versus other investors. I think what struck me about that example, that case though, is that it was a very long dispute. That there were workers with, decades of experience at Clark who would never taken a day's industrial action in their life, would never have dreamt of it, who spent weeks and weeks and weeks on the picket line, and took very, the union has a strike fund, but basically took huge cut in terms of pay to protect their interests. They felt they had absolutely no option. And the Lion Capital, on the other hand, argued until the last minute that it had absolutely no choice but to take this action. And then it caved in. So, it clearly did have a choice. And I think my slight concern about kind of framing it as like, oh, these funds know about ESG? It makes it seem like a bit of an add-on. But I think that at the end of the day, there are different ways of companies making profits. There's a high road and there's a low road. And in this case, the model that was being adopted was kind of very much the low road, sort of fire and rehire, and kind of cutting jobs, cutting wages, and all the rest of it. And there's a high road which involves investing in stuff and so on and so forth. that's not that's not something that only private equity companies do wrong, you know, unfortunately. But in that, it kind of they switched over, you know, very late in the day in that case.
Janet, can I jump in, because I'm conscious of time. It would be very unfair to ask Michaela to respond directly to your comments, because I know that I suspect that everyone on the panel has comments and reactions as well. So Michaela, maybe I can just hand it over to you to say what you perhaps you're already going to say, and I'm sure you have some comments on things that have been raised already, but let's hear your thoughts.
Thank you. And thank you for having me in, Janet. Thank you so much for your comments and all the other panelists. I'm not going to try to unpack them all in one go, but I'll definitely try to answer some of them of what's been said. So my name is Michaela. I work for a company called Greenbrook, and I advise investment managers on their ESG practices. And generally that can be both in terms of how to integrate ESG into your own practices as a GP, how they integrate it into investment process, and also how they disclose an ESG. And I think disclosure here is immensely important to add on to this debate, because Louise already alluded to it, right? But some private equity firms are disclosing publicly on their website via an ESG report or kind of a separate tab on ESG or sustainability. And some of them are mainly doing it to investors, and there's no kind of proof to the outside world that they're working at all with ESG and that this is important for them. And even when they are reporting on it, there's still a confusion, right? And I saw one of the comments or questions that we have in the chat box about, is there, you know, is there a will to change, or, you know, do we kind of rely on doing what we always done because it's comfortable? And I think ESG is a term, you know, I work with this now almost 10 years. It's changed enormously. When I started working with this, my colleagues, when I said ESG, they immediately associated that to philanthropy and thought, okay, this is what we're talking about. And they gave me wonderful examples on how they were donating to schools in Africa, or, you know, involved in the local community. And I said, that's not really what we're going to talk about here, right? We're going to talk about how it relates to business objectives. And some firms are really good at helping their portfolio companies making that link, which then, of course, leads to an alignment of interest. And some firms have a little bit longer to go on that journey, if we're going to be honest with it. I think when it comes to profit sharing, you know, that's something that we're seeing in certain geographies in Europe, where private equity firms are consistently kind of putting a profit sharing mechanism in place with the companies they're investing. And that's really interesting. We've also seen some examples from the UK market, but it's not the standard practice, obviously, for all private equity buyouts. And I also think we need to be kind of open and honest with the fact that, you know, this is an industry where we love the use of acronyms, and ESG is another one. It keeps on growing every year. We didn't speak about cybersecurity 5 years ago that much. We didn't really speak that much about climate change or biodiversity. These are new terms. Nowadays, we're speaking about equity rather than equality. We're talking about DE&I. And it's hard for anyone to be an expert. Even myself, who has the lovely title of, you know, head of ESG advisory, do not sometimes feel like an expert on this. So it's not that easy for companies that are either starting their journey, and they might use a completely different set of terms, or they're kind of somewhere in the middle of it to understand exactly what we mean. And here, I think, Janet, you made a really important point in terms of, okay, the impact of workers. Some firms, when private equity firms, when they are disclosing about, they might say we have grown the portfolio's kind of work numbers so and so much, but they may not exclude add-on acquisitions. And that gives us a false sense of the actual growth in terms of jobs. And I think that's one, it's a simple example, but it's very common mistake when it comes to ESG disclosure. They don't really mean to embark on greenwashing. They don't really see it as greenwashing. But it is really important to be transparent and knowing how to disclose ESG data.
Great. Thanks, Michaela. I should have said earlier, we are getting a few questions and comments coming in through the chat box and the Q&A box. I would encourage anybody that has a question or a comment or who wants to challenge anything that's already been said, please feel free to do so. It makes it a more interesting discussion amongst them, as much as anything else. But Simon, Louise, coming back to both of you, first of all, because Janet has made some fairly provocative statements and comments. It'd be very interesting to get your perspective on what she has said and some of the challenges that she's thrown out to the industry. I think some of the issues about financial engineering are perhaps a point of view, but some of the issues about specific behaviours of the industry and whether we need to recognise that there are good players and bad players. Interested to get your views. Maybe Simon first, because you clearly look at a lot more than one firm.
Yeah, happy to. I mean, clearly in any industry, there's deals that go well and deals that go badly, and there are good players and bad players, if you like. And I don't want to comment on specific cases because I just don't have the data, the facts. And you know, I'm very interested to hear you know, the TUC and Janet's perspectives. I suppose one thing I would pick up on that Janet said was this question about kind of 5 years being a long time and whether or not the business is long-term sustainable in private equity hands. And I just come back to something I said a couple of times, I think, in my opening remarks, which is that to me, it's not the 5-year ownership period is almost irrelevant. What's important about the ownership period is whether it's long enough to make a strategic change in the business that makes the company more valuable. But what matters to a private equity firm generally, and I accept that there are other, you know, there are exceptions, there are other ways of making returns, but generally speaking, on the whole, for the vast majority of firms in the vast majority of cases, what they're trying to do is to make a business more valuable in the long term, because that's how they'll maximize the price that they sell it for at the end of the 5-year period. So the 5-year ownership period it might be 3 years in some cases, it might even be less. In some cases, it'll be many more. I think the average at the moment in the UK is running at about 5.9 years. But the point is that during that period, whatever it might be, the firm has an incentive to try and make sure that when a buyer comes along and it's a buyer who's going to be incredibly well informed about the sector, who's going to do a huge amount of due diligence, and you're going to be in a sort of competitive auction process where you have to really allow everybody to open the bonnet of the business. You know, the incentive of the private equity firm is to make that business as long-term valuable as it can, and that's why I don't think that owns it for 3 years, 5 years, or 7 years is really the point. It's what its objectives are during that period that really matters, and what its incentives are. Might I just pick up on something that Shai said as well, David? If of course, yeah. A couple more minutes, because one thing I've tried to do quite carefully in my opening remarks is to make a distinction between financially material ESG matters and things that don't necessarily have a direct financial impact on the underlying business. And I'm getting a bit of background noise. I don't know.
Shy, it's a little noisy at your end, I think, if you don't mind.
Yeah, sorry.
Thank you. So yeah, so I was made a distinction between financially material ESG business drivers and others. And in the case, I take Shai's point that there hasn't been, I agree that there hasn't historically necessarily been a kind of the same level of analysis of ESG data, and there certainly isn't and hasn't been the same level of public disclosure of that data as there has been in other parts of the financial sector. But what I would say is that where you're looking at financially material ESG factors, I find the boards of directors really do get them, and they really do focus on them because they're financially material and they're smart people and they understand the business and they understand the sector and they understand what buyers are going to be looking for. For other ESG factors, I think we have seen a step change over the last few years, because I think in those cases where there isn't perhaps the same financial incentive for the private equity firm to focus on them as business drivers in the underlying portfolio company, there is now nevertheless, as I said before, a stronger focus from the institutional investors that invest in private equity. And so we've seen in the last few months, over 100 firms sign up to this global data convergence project, where GPs are committing to collect certain metrics and report them in a standardized way to their institutional investors. We've seen, and I certainly see in my practice, a much bigger focus, particularly by European investors, on understanding the ESG, including non-financially material ESG issues that private equity firms are looking at, and what the performance of their underlying portfolio companies. So I think in the case of financially material issues, I think that to my mind, those have always been things that private equity firms have focused on. What we've seen is a dramatic shift in how ESG factors have become financially material over the last few years, and for certain businesses, climate change is absolutely business critical now, as we know, and you just have to focus on it if you're interested in value creation. But I think what we've seen more latterly, and this is perhaps what Shai's seeing, is a more generalized focus on ESG data collection and reporting, across the board, perhaps, rather than just on the 2 or 3, clearly financially material ESG issues.
Can I just also give my reflection on sort of employees, and obviously I can't make excuses for every decision any PE owner has made. But in many ways, I think the S of ESG is easier than E in terms of sort of financial value, because ultimately, when I think about the businesses we invest in, they are people businesses. And if we don't get the culture right in those businesses, we don't attract talent and so on, we are not creating long-term value. And when I think of us as a buyer of a business, the first thing we'll do is go and look at Glassdoor and look at employee references on a company and how they've been treated. And if those were negative, we wouldn't touch it with a barge pole. So clearly, when we think about the business we are creating, the same point holds. And I do think, there's been a generational shift in what employees are looking for as well. And it's so important to address that. COVID has obviously changed things as well, but thinking about how companies are providing hybrid working practices, or almost non-financial benefits to employees, which many younger employees value as much, if not more, as financial benefits. All these considerations are so critical to the success of a company ultimately. It is a shame, Janet, that there are inevitably sort of public and private company issues, and perhaps more related to when companies go wrong than not. But I would say, for companies where the intention is to build value in the company, there is a huge amount of focus on that S element.
I have a somewhat more cynical view on some of these issues as well. I think I mentioned this to some of you in the past. I have a very good friend who sits at the heart of the private equity industry, who is probably one of the most red-blooded, unreconstructed, old-fashioned capitalists that I've ever met, and whose mission in life, he believes, is to make money for his investors. But he says to me, that meant, in the old days, let's be honest, ESG was a secondary consideration unless they were materially, financially important to us. Today, that's at the heart of what we do. Not necessarily because I think our job is to make the world a better place. It's at the heart of what we do because our investors are demanding it of us. And if we don't behave in the way that our investors want, we're going to lose our business. So for me to make money for our investors, for me to make money for myself, requires me to have a state-of-the-art ESG process, purpose, and data to demonstrate that we're doing that. And it isn't even. It's sort of a second derivative, because his investors are those institutions. Those institutions, it's not their money either. It's the Texas Teachers Pension Fund. It's the teacher, and I've been to a Texas Teachers annual meeting because I used to do a lot of work with them. The teachers are there in their meeting, the individuals, and they care deeply about social issues. They care deeply about sustainability issues. And so, if Texas Teachers isn't holding their managers to account for doing that, they're going to get pressure from their own membership. So there's a huge sort of societal pressure that's driving behaviour, which even my unreconstructed capitalist pig of a friend is going to change his behaviour dramatically, and it really has done. sorry, it's a point of view I just thought was interesting.
Just to expand on that point, I mean, I think you're absolutely right. I sense it's going one step further. So obviously there are various pieces of regulation or disclosures required, and some of these LPs are trying to bake those into their capital allocation decisions. So just to use another acronym in the ESG alphabet soup, SFDR, where do you sit in SFDR? And some LPs are thinking, okay, well, we'll do X% of Article 8, X% of this, and it's becoming a more sort of black and white allocation decision rather than just a requirement of GPs.
Can I add something?
David, can I just make, sorry,
go ahead. No, go ahead, Jen. No, after you, Jen.
You go ahead, Janet.
Okay, thanks very much. Yeah, if I could just make a couple of sort of quick comments in response. I mean, I think the point about financially material ESG and financially not material ESG, I think it's a very tricky argument. As somebody's just kind of said, that kind of shifted over time, by which I think probably we mean perceptions have shifted over time. And I think there are quite a lot of ESG considerations where it can be difficult to really pinpoint an exact sort of direct link between a particular issue and the bottom line. And yet you take a step back, and in a general sense it's very intuitive that most if not all ESGs do have in the long term some kind of an impact on the long term success of a company. So I think the issue about time horizons is important, and some of what probably can happen with private equity ownership does come down to the time horizons. I take your point, Simon, around the need for companies to be resold, but that is also where we have sometimes seen some real difficulties. Sometimes it's been difficult for private equity funds to sell companies which have been, to use a bit of a kind of cliche term, sort of asset stripped. But that has been a phenomenon which has happened quite widely, and sometimes it's actually after several generations of, several transfers of ownership that real problems have kind of set in over time. So I just sort of flag that up. And the main point I'd really want to make strongly, though, is that I think disclosure is important, but it is not always a reflection of practice. So, we've seen a huge increase in ESG disclosure, across the board, and it's pleasing if that's, filtering into the private equity industry, in sort of stages as well. And I do, genuinely believe that disclosure can be a driver of change, but it's not the same as change. It's not the same as practice. And, there's no doubt whatsoever that the S has kind of risen up the ESG agenda in recent years. That's extremely welcome. It's been the poor relation for very many years. But on the other hand, we have to have a reality check that in terms of employment, that's not the total of the S, but it's an important component. Overall, and to talk in broad general terms, employment conditions have not improved commensurate with that increased investor interest in workforce issues. And I very much welcome the increased interest in investor is interested, but it's not translated into improvements in employment relationships and employment practices and wages and so on and so forth. So real wages in the UK are still lower than they were before the financial crisis on average, and we're still we're stagnant all the way up to the pandemic, and basically obviously taken a further hit now, but even going back to that pre-pandemic period. And unfortunately globally the picture is dire as well. So we need to look at what is happening on the ground, and in my focus is on kind of workforce terms and conditions, wages and so on, and obviously the ESG agenda is broader, is much broader than that as a whole. But yeah, I just wanted to flag that disclose information and actual improvements of practice are not the same thing.
Yeah, I think we'd all accept that. I think a lot of the points you're making are not necessarily specific to private equity either. I think we're talking about a capitalist system. But Shai, you had a point to make.
Yeah, I just wanted to make 2 points. I'll try and be quick. And they're about financial materiality, firstly, and secondly, double materiality. So on the point of financial materiality, and again, Simon's point, if you go into a private equity firm and say, do you care about issues that are financially material? You'll get one answer, which is, yeah, of course we do, you idiot. That's what we're about. The point being is then the second question is, well, if ESG issues are financially material, then why aren't you caring about them very deeply? And the answer is because of the huge divergence of opinion on which ESG issues are financially material to a specific company. And private equity firms, a lot of private equity firms, smaller, are really not making a lot of progress answering those questions. And when I speak to them, I say, well, you need to go and speak to someone like Greenbrook, right? Go and speak to someone that will actually advise you and telling you about this. And sometimes, you know, they formed their own ESG committee. It came up ESG committee. I mean, I've got some comedy stories that I can't, of course, share about who is on the ESG committee. Some of these private equity ESG committees, I mean, they pretty much like one evening dragged the cleaner who was pulling their Hoover down the corridor onto the ESG committee. I mean, there's just a dearth of expertise there. Then they rely on statements like, oh, we're members of the PRI, we're UN PRI signatories, which basically means you commit to 3 basic commitments on having a policy. You mark your own exam paper every year, and you get 3 years, even if that commitment is woeful, you get 3 years to put it right. So UN PRI membership is the biggest rubber stamping in the investment industry. And you get a lot of people referring to that. So what I'm saying to them is I completely agree. ESG issues, if they're financially material, they will be focused on, they will be taken very seriously. But most private equity firms of smaller size need help from ESG consultant firms like Greenbrook, whatever, to advise them on that. And that approach is sector specific. That's sector specific. So the data convergence project, which I've been on calls about, which is moving glacially, is all about universal environmental metrics, right? And how they should be measured. Most of them which aren't actually that relevant to the company. So I am trying to be optimistic and say things are moving in the right direction, but they're moving too slowly. And the main reason is because a lot of private equity firms don't appreciate that it's necessarily a value driver. And if they do, they don't know which metrics are actually financially material. They're not confident enough to work it out. And everyone wants to speak, so I don't want to hog it. I just want to come back to Janet's point about double materiality. Janet's actually making a very profound point, right? Which is about investment. I don't think it's about private equity, which is the difference between financial materiality and double materiality. Financial materiality is you assess ESG issues of a company from outside in. How are these issues affecting the value of this company and challenging it? Double materiality looks at this, and it also looks inside out. How is this company affecting the wider world, and what are its broader responsibilities? Issues around how you treat your staff, well, they can be both. You know, as Louise would say, well, that's financially material to us. We'd never invest in a company that treats its staff badly. Obviously, Lion Rock Capital, when it bought Clark's, or DP World, the Dubai private equity behind P&O Ferries, doesn't think that treating your staff like that is financially material. It's probably quite taken aback as to why all these people are so upset about it, right? That is double materiality. And what I'd say to Janet is that's a broader question. Most investment firms are not focused on double materiality at all. They are focused on financial materiality. That is a fact. But on a note of optimism, I spent Monday talking amongst other people to Vincent Kennedy, Lord Mayor of London, and John Glenn, Economic Secretary to the Treasury. And, you know, they are very clear. Their determination is to make London a centre of impact investment. There's going to be a big impact summit in July. So have hope, Janet, that actually double materiality might actually become a regulatory requirement over time on these companies. I'll now shut up. Thank you, David.
Thanks. Michaela, were you trying to raise your hand? I think you were.
Yes, I did indeed. Thank you. So I've done the in-house private equity 6.5 years, and I know for a fact that at least we didn't, and I'm sure a lot of other private firms, we don't only ask for financial material KPIs. We ask for a lot of KPIs that are not necessarily financially material either, because it is really, as Shai said, it's really hard to judge. And I think you need to be very humble about the fact that, sometimes it will be a requirement from the institutional investor in that fund. And that's a tough conversation to have with the portfolio company if they're asking, why should we report on this and say, well, actually, because we have underlying investors in our fund who's asking for this type of data. Some of it will be business specific, and that might be financial material, and some of it might be what you want to know on a fund level as a GP as well. So it is quite a broad set. What's really important here is obviously that you have a direct discussion with the portfolio company in question and an alignment with them, right? Because otherwise what happens is when you actually exit your stake in this company and it's sold, they're going to stop measuring all of this and all the data will get lost. So I think it is a tricky topic, and you're spot on for kind of bringing it up.
I think we've been addressing a lot of the questions as they've been coming up. There's one question in the Q&A box which I'm going to paraphrase. I'm also going to mispronounce the name of the questioner, which I think might be something like Yahya Alamari. And I'm paraphrasing the question, and it's to the effect that our private equity firms, I guess this can be broadened out to many firms, but are we using sort of historic data on things like CSR and employee engagement to feed sort of ESG data that we're looking at, and are companies going through a fresh start now because they're being required to comply with ESG reporting? And I might ask you, Louise, first, and possibly Shai as the data person.
Sorry, just reaching for the unmute button. If I think about our own firm, if I'm being very frank, 5 or 6 years ago when we thought about this, we did really formalize a lot of our processes, and where, undoubtedly some of this information, some of this data would have been collected and reported on. Some of our companies would have focused on it while others may not have done. It was a sort of fresh start in terms of the approach we took and how we reported to our investors as well. Because frankly, there was probably stuff we were collecting at that point that our LPs hadn't begun to care about. So responding to what we thought they wanted to know about and what was more for sort of internal monitoring and measurement and so on was important. So I think we've learned as we've gone along. One of the challenges I would say is you've almost got to chart your own course and sort of decide what is right, because there are various pieces of regulation, disclosures, principles. To your point, Shai, which one do you sign up to? Is it the SDGs? Is it, sort of how do you think about it? And you've almost got to be a bit blinkered to it and think again, what as a firm do you really care about, and what should our companies in the space they operate in, the nature of the businesses they do, what should we care about? I'm not sure if that answers Yahya's question, but that's certainly the approach that we've taken.
Thanks. Shai, I don't know if you have any further comments, but
yeah, I don't want to speak for too long because I'm a person. I think most companies are starting from scratch. To Yahya's question, as I said, I think a lot of PE firms, they have the initial report on acquisition. We looked at it. They often got a third party to do it, and they've got a pretty good report actually. And it's in there, so they could take that out and say, could you refresh this report actually that was done for us by whoever, ERM or EcoVadis or something like that. But PE firms, I'm not one, but I think PE firms tend to be, correct me if I'm wrong, Louise, obsessed with benchmarking. So it's like whatever you measure, by the way, I don't want to just measure it for this company. I want you to show how this shoe manufacturer looks against all other shoe manufacturers. So then we can tell whether it's good or bad and how much it should be able to improve. So we say start again with a system that will allow you to benchmark this company to a whole bunch of other companies that do what they do, right? So a sector-specific approach, but also one that can be applied and has been applied to many, many other companies that do the same thing, many of whom are public as well as private.
Thanks. I'm really furious with all of you because I'd written a whole load of questions that I was going to pepper into the conversation as we went on, and I think every single one that I'd written down has been addressed by the panel. So I should congratulate you, but it's meant that my scribbling down of homework last night was a complete waste of time. I think it's been a fantastic and really fascinating conversation. I come away from this reasonably encouraged, not completely convinced that the private ownership industry is moving us in the right direction. I think we've heard some very encouraging comments. I think we've heard some equally concerning warnings of things that are still not necessarily being done correctly. I would invite any of the panelists that have any closing comments or concluding remarks that they'd like to make, reactions to things that have been said, so please feel free to say so.
Can I jump in and make a few comments, David? So I just wanted to say that one of the things I think is really important, and one of the things that I think we might all be agreed upon, is that one of the what's changed in society, and what's changed for I think pretty much all underlying businesses that private equity firms invest in, certainly those of any size, is that there are so many issues now that have a financial impact on the business that perhaps didn't 5 or 10 years ago. And so I think one of the things that is increasingly being recognized across the financial sector, including in the private equity sector, is that if you can have a positive environmental or social impact on a business, then that can generate additional value creation. And so, to your point about your friend, if somebody is focused on capitalism, if somebody is focused on making money out of the investments that they make, or to put it slightly differently, if you're a pension fund investor trying to maximize the pension pot for your beneficiaries, then doing good and doing well are increasingly correlated. They do go hand in hand, and I do think that the private equity industry does get that for the most part.
Listen, I think that's a tremendous note on which to end. Unless anybody has any further concluding comments, I would then very much like to thank all the panelists. I think it's been a tremendous conversation. I really applaud all of you for having given a lot of thought to this and given us a really interesting conversation. Chris, I'll hand it back to you. I guess the reminder is that this is also recorded and available. Anybody that didn't participate, any of you that have friends that will benefit from this, steer them towards Chris and the website.
Yes, that's right, David, and we'll publicise the video on our social media accounts, Twitter and LinkedIn, as soon as it's available. I have nothing really to add to your summing up, other than to thank you for the excellent moderating of the session. Thank all of the panel for their involvement and the passion and enthusiasm that they obviously bring to the subject. We managed to avoid a total fist fight, which was slightly disappointing, but I suppose that's more difficult to arrange virtually. But there's certainly a lot of food for thought from all of you. I'm sure everyone who was able to join us will have appreciated that, and we will get it out to a wider audience as soon as we can. So with that, thank you once again. Thank you, Heidi, for organising the session and keeping us on track, and all the best. Thank you.
Okay. Thanks very much. Bye-bye.
Thanks all. Bye.
Bye. Bye.
Thank you.